Bismillahirrahmanirrahim. Today the subject is financial statement analysis, and today topic is on analysis of inventory. In this lecture we will cover the topics about inventory valuations, valuation method and its relationship with financial reporting, means what these method will have any impact on financial reporting, such as gross profit, such as cost of sale and inventory and balance sheet. Then we will explain it with the numerical illustration. So what is inventory? Inventory means different thing with respect to organization. If it is wholesaler or merchandiser or retailer, they purchase inventory, ready-made goods from manufacturer and then sells it further. So there is only one type of inventory, which is called finished goods inventory. But in case of manufacturer, the manufacturer purchase raw material from supplier and then add value, means these raw material are then converted into finished goods by adding values, by adding direct labor and factory overhead, direct labor in FOH, factory overhead. These two cost and current these raw material and then converted into a finished goods inventory. So manufacturer will have three type of inventory. One is raw material, work in process inventory, and finished good inventory. Finished goods inventory. So these, what I describe is that manufacturer have three type of inventory: raw material, work in progress, and work in progress or work in process, and finished goods. So you will see these three type of inventory in the financial statement of the manufacturers. Now inventories means either it is merchandiser, means wholesaler or retailer or manufacturer, it will have inventory which we call cost or inventory available to sale. Cost of goods available or cost of sale means we have inventory. Let's suppose that is our inventory. We assign this inventory to two things: cost of sale during the period and finish, ending inventory. Ending inventory or closing inventory. So inventory at the start or goods available for sale is allocated into two heads at the end of the year: cost of goods sale and ending inventory. Inventories and cost of sales, cost of goods sold, are significant item in the financial statement of the many companies. So these two things, cost of sale and inventories, you will see these both items in the balance sheet of every company. So it is important to discuss its impact on the financial statement, its valuation methods, and reporting, and its impact on reporting, financial reporting and analysis. Now, why it is important to study these two things? Because if the company uses same valuation of inventory, if they are using same valuation of inventory, means if all companies are using FIFO methods, then there is no issue in comparison of the financial statement. if some company using FIFO and other companies using LIFO and some company uses weighted average cost of capital, then we will face a challenges in comparing the financial statement of the companies. So comparing the performance of these companies is challenging. When it is challenging, because of allowable choices for valuing the inventory. IFRS and US United State GAAP allowed the companies to use different inventory methods. So if they are using different inventory method, then it will be hard for the investors or analysts to compare these financial statement. Moving further, financial statement analysis would be much easier if all companies use same inventory valuation method, or if inventory prices level remain the same. Two things impact the there are two factors that have an impact on the financial statement analysis due to different valuation method of inventory. One is inventory valuation method, and other is inventory price level. If price level remain same, LIFO and FIFO will give same result. Weighted average, LIFO, FIFO will give same result. If same inventory method is used, then if there is different inventory price level, again the under financial statement analysis will be easy to compare amongst the companies. Secondly, when we're talking about the price level of the company, if there is no inflation or deflation with respect to inventory cost, then unit cost were unchanged, the choice of inventory valuation method would be irrelevant. As I told you earlier, if inventory price level remain the same, then inventory valuation method doesn't have any material differences between the inventory valuation methods. So if there is no inflation in the economy or no deflation in the economy with respect to inventory cost of the firms or the companies, then the unit cost remain unchanged. So then inventory valuation method would be irrelevant in reporting the cost of sale and inventory in the balance sheet. But in practical world, it is hard. The price level will not change. So a price level do changes over time. International financial reporting standards permits methods permit the firms to assign cost of goods sold available for sale to inventory, and cost of sales means cost of goods available for sale will be allocated to further accounting head, what is called cost of goods sold, which we called cost of sales or cost of goods sold. Secondly, it would be assigned to inventories. So, but this allocation is based on formulas. First method that is allowed by IFRS is specific identification method, and second method is first in first out, and then third method is weighted average cost of inventory. In US generally accepted principle allow the three methods as discussed earlier, which is called FIFO, specific identification method, and weighted average cost of inventory. But the US GAAP also allowed one fourth method, which is called last in, first out, which is that is known as LIFO method. Now, the choice of inventory valuation method affect allocation of cost of goods available for sale to ending inventory and cost of sale. As I told you earlier, the cost of goods available for sale is allocated to these two heads: ending inventory and cost of sold, cost of sale or cost of goods sold. But inventory valuation methods, either it is LIFO, FIFO, weighted average cost, or specific identification method, affect what? This allocation of cost. We will discuss it in further slides. Now, as an analyst of the financial statement, you must understand the various inventory valuation methods and related impact on financial statement and financial ratio in order to evaluate the company performance over time relative to industry peers or related to industry competitors. Now, cost of inventories. How international financial reporting standard allowed lower of cost or market. Valuation will be lower of cost or market. If market value is less than the cost, then we will report market value on the balance sheet. Under IFRS, the cost included in inventory are all cost of purchases. First, cost of conversion for manufacturers means direct labor and factory overhead. Second, in other costs incurred in bringing the inventories to their present location and condition. Now, the cost of purchase include what? This first one. Cost of purchase include purchase price, import and tax related duties, transportation, insurance during the transport, handling, loading and unloading, which we call, and other costs directly attributable to the acquisition of finished good or raw material or any other services. These are not included in the trade discount, rebate, and similar item reduce the price paid to the cost of purchases. So these will be deducted if you get any trade discount or get rebates or any other similar items. The cost of conversion include what? Cost directly related to the units produced, such as direct labor and fixed and variable factory overhead cost. Now, product related cost of inventory as an asset means that they will not be recognized as an expense. Those product related costs which we embed which we calculated in the inventory unit, it will be reported as an asset unless and until the inventory is not sold. So the product related cost in inventory mean that they will not be recognized as an expense, cost of sale on the income statement until the inventory is sold. So unless and until inventory is sold, the cost of inventory will not be recognized as cost of sale. Both IFRS and US GAAP exclude the following costs from inventory. Any abnormal losses during the production process is which result is a waste of material or labor or other production overhead inputs. Any storage cost unless required is a part of production process, and all administrative overhead and selling costs. So these costs will not be included in the cost of inventory. Again, abnormal losses if it occurred during the production processes. Any storage cost unless required is a production part of production process, and administrative costs. These will not be included in the cost of inventory. So these excluded costs are treated as expense for the period. It is not product cost, it will be treated as a period cost and recognized on the income statement in the period in which they incurred. As I told you that it will be treated as a period cost and will be charges and expense during the period in which it is incurred. Including cost in inventory deferred, their recognition is an expense on the income statement until inventory is sold. Those costs who are included in inventory, it will be deferred, but means it will not be recognized as expense unless we sell the inventory. But those costs who are excluded from the inventory, cost will be treated as an expense. Now, cost of inventories, we will explain it with the help of this illustration. There is an hypothetical enterprises that ACME, hypothetical company that prepare its financial statement in accordance with the IFRS and it manufactures tables. In 2009, the factory produced 900,000 finished table and scraped 1,000 table. Means that is abnormal. As for the finished table, raw material cost was 9 million. Direct labor and conversion cost were 18 million, and production overhead were 1.8 million. So this is the cost for these 900 finished goods, means 900 finished table. This 1,000 scrap table attributed to abnormal waste had total production cost 30,000, 10,000 raw material and 20,000 conversion. These costs are not included in 9 million raw material. It will not be treated here. And 19.8 million total conversion cost, it is not included in this total, this one and this one. Conversion cost of the finished table. During the year, SCME spent 1 million for freight delivery charges on raw material and 500 for storing the finished goods inventory. SCME does not have any work in progress inventory at the end of the year. So what is required? Required is what should be the included in the inventory in 2000 and what cost should be expenses. Let's discuss here briefly, and then we'll move to the next slide. We will include this 9 million as an inventory cost, this 18 million, this 1.8 million, and this 1.1 million freight charges, but we will not include these 30,000 and these 500,000 because this is abnormal losses as we studied in earlier lecture, and this is storage costed. So moving further, as I told you that Inventory cost for 2009 will be 9 million. Raw material, 18 million direct labor, 1.8 million factory or production overhead, transportation of raw material 1 million. So the total cost is 29,800,000 euro. Now, total cost that should be expensed, that we charge as an expense or as a period cost is 30,000 is pound is 30,000 euro is abnormal losses that will not be included in cost of inventory. In storage and finished good, storage of finished good inventory cost will also not be included in the cost of inventory, so it will not. So 30,000 will be treated as an expense for that year 2009. Inventory valuation method. Generally, inventory purchase cost and manufacturing conversion cost change over a time. If you are a retailer and you are going to purchase inventory, or you are a manufacturer and you are going to produce finished goods, or manufacturer going to finished good, in both cases, the cost is changing over a time. So the cost of sale on income statement and inventory on the balance sheet will vary depending on the inventory valuation method used by the companies, because the company will use a different valuation method. If the choice of the method result in more cost being allocated to the cost of sales and less cost being allocated to the inventory, then would be the case with other method, then the chosen method will cause in the current year reported gross profit, net income, inventory carrying amount to be lower than if alternative method had been used. LIFO, let's suppose, is one method and FIFO is another method. FIFO is another method. Since FIFO will allocate more cost to cost of goods sold and less cost to inventory, FIFO method allocate more cost to cost of sale and less cost to inventory. What will happen is, compared to this LIFO method, what will happen is the result that in financial statement reported gross profit will be lower under FIFO method, net income will be lower under FIFO method, and inventory carrying amount will be lower under FIFO method as compared to using the second option of LIFO or weighted average cost of capital. So company using following company are allowed to use these method: specific identification method, first in first out method, and weighted average cost of method, weighted average cost method, and last in first out method. We will discuss each in detail coming slides. What is specific identification method? In specific identification method, these items are not ordinarily interchangeable. Means each item have specific attributes and they are not similar. So specific identification method is used for inventory item that are not ordinarily interchangeable with each other, and for goods that have been produced and segregated for specific projects. Secondly, this method is also used for expensive goods that are unique, identifiable, such as precious gemstones. And third, under this method, what has happened in this method? Cost of sale and cost of ending inventory reflect actual cost of incurred purchase. Means when you are going to purchase and report in and report it in the system, and there is physical flow in inventory, these physical flow of inventory and flow in the paper are identical. So actual cost incurred to purchase, manufacture the item specifically identified is sold and the item specifically identified remaining inventory. So this method the physical flow of specific items sold and remaining in inventory to their actual cost. Means physical flow of the inventory of and reporting cost are same. Even first in, first out method. First in, first out method assumes that the oldest goods purchased or manufactured are sold first, and newest goods purchased or manufactured remain in inventory and ending inventory. Means let's suppose this is your storage and these are your inventories. You purchase it first, in second row, this is third order, and this is fourth order, this is fifth. Now, first in means first out. If you sell 6 items, these 6 items, not physically these 6, but we will allocate of cost, first cost of these 3 items and then cost of these 3 items, while these remaining 6 will be in inventory. So this is that the oldest goods purchased or manufactured are sold first, and the best goods purchased or manufactured will remain in inventory. Therefore, cost of sale reflects the cost of goods in the beginning inventory plus the cost of item purchased, manufactured earliest in accounting period, and the value of ending inventory reflects in the cost of goods purchased or manufactured more recently. Hello? जो क्लास किया उससे करता हूँ. So in a period of rising prices, the cost assigned to the unit in ending inventory are higher than the cost assigned to the unit sold. Why it will be higher? If there is rising prices, we will buy these 6 items at lower prices. This one at lower, this one a bit higher, and this one higher than this, and this one higher than this. So the goods who remain in ending inventory will carry a high cost, while the goods who will go to cost of goods sold, these 6, it will carry lower amount or lower cost. So in rising prices, the cost assigned to unit ending inventory are higher than the cost assigned to the unit sold. So we will lower cost of goods sold and higher inventory in the balance sheet. And conversely, in the period of declining prices, the cost assigned to the unit ending inventory are lower than the cost assigned to the unit sold. If the prices are declining, so if it is declining, these will be these first purchase unit will carry a higher prices, then this will lower in this, then lower than this one, and it will be lowest prices. So under FIFO method, this cost of goods sold will be assigned, the unit sold will be assigned a higher cost as compared to the unit which remain in inventory will carry a lower, will assign a lower cost. Weighted average cost. Weighted average cost assigns the average cost of the goods available for sale during the accounting period to the unit that are sold as well as to the unit in ending inventory. What it means? It means if we have, let's suppose, we will add total cost of the inventory that is available for sale. In this total unit available for sale, we will divide it. We will get a unit cost. In this unit cost will be equally applied to cost of sale and cost of goods sold. Further, LIFO method. LIFO is not permitted by IFRS. It is permitted only by US GAAP. So the newest goods purchased, it means that the newest good purchased or manufactured are sold first. It is assumed in this under this method that the newest most recent good purchased or manufactured are sold first, and the oldest good purchased or manufactured including beginning inventory remain in inventory. Again, if this is our store and we purchase this one first, these three, and this three in second order, this is, let's suppose, beginning inventory, this is order during the year, this is second order, and this is third order. Under FIFO method, if we sold 5 units, we will sold those who are recently purchased or recently manufactured. Will we go to C, G, S, and this will be assigned to inventory. So the oldest unit, this is beginning inventory, and oldest order purchased will remain in inventory. What will happen? Higher cost will be assigned to, and in rising prices, higher cost will be assigned to cost of goods sold. In lower prices, or lower cost will assign to inventory. Now, last unit included in inventory are assumed to be the first unit sold from the inventory. Cost of sale reflect the cost of good purchased, manufactured more recently, and the value of ending inventory reflect the cost of goods, older goods, as I explain it here. In the period of rising prices, what will happen? Cost assigned to the unit in ending inventory are lower than the cost assigned to the unit sold, and under the declining prices, the cost assigned to the ending inventory are higher than the cost to the unit cost assigned to the unit sold. Inventory valuation examples. Let's suppose there is a global sale company is hypothetical distributors of consumer product including bars of Violet Essence soap. The soap is sold by the kilogram. The global sales incorporated began operation in 2009, let's suppose, during which it purchased and received initially 1000 kg of soap at rate 110 rupees per kg. 110 rupees per kg. So 1000 first order is 100,000 kg of soap at a rate of 110 rupees per kg. Second order is purchased 200 kg of soap at a rate of 100 rupees per kg. And finally 300 kg soap is purchased at 90 rupees per kg. So there are 100 plus 200, 300 plus 300, 600 kg soap have been purchased but at three different price level. Now they sold 520 kg of soap at a rate of 240. Global Sales Incorporated store its soaps in its warehouse so that the soap from each shipment receives is readily identifiable. I mean they store and they identify that which order is placed in which place. During 2009, the entire 100,000 kg from the first shipment received, 180 kg of the second shipment received, and 240 kg of the final shipment received was sent to the customer. So they identified that 100 is from first, 180 is from second, and 240 from third shipment of the final was sent to the customer. Answer to the following question should be rounded to the nearest 1000 rupees. Now, what are the reported cost of sale, gross profit, and ending inventory balances for 2009 under the specific identification method? Second requirement is what are the reported cost of sale, gross profit, ending inventory balances for 2009 under weighted average cost method? What are the reported cost of sale, gross profit, ending inventory balances for 2009 under FIFO method? What are the reported cost of sales, gross profit, and ending inventory balances for 2009 under the LIFO method? First solution. Under specific identification method, physical flow of the specific item sold is matched to their actual cost. Now, sale is 520,000 units or kg multiplied by 240, that is 124,800,000 rupees is sale. Cost of goods sold, since 100 is from the first shipment, so we know that 100 have cost. First shipment cost 110 rupees per kg. 180 is from second, which cost 100 rupees per kg, and 240 is from the third shipment, which cost 90. So specific identifiable we apply, since we know that 100,000 is from first shipment, we apply this cost. Quantity from second shipment we apply this cost, and 240 from the third shipment we apply this cost. Total cost of goods sold is 50,600,000 PKR. Now gross profit is equal to sales minus cost of goods sold, that is equal to 74,200,000 PKR is gross profit. Ending inventory is, since there is 600 units, when 520 have been sold, we left with 80,000. 60,000 units. Now ending inventory, 20,000 left in second shipment. We will multiply it by 100 because we identified it. And 60,000 remain in the third shipment, which cost 90,000. So we identified that 60,000 from second shipment. So the third shipment have been remain in inventory, 20,000 from the second shipment. So inventory cost is 7.4 million PKL. But it is inappropriate to use specific identification method for this inventory because these are interchangeable items. These are similar items in so as every kg you don't identify that this kg is different from this kg of soap. Now moving further, under weighted average cost method, cost is allocated to the cost of sale in inventory by using weighted average cost of inventory, mix of the actual cost incurred for all inventory. How we will do it? First we will calculate unit cost, average unit cost. So the average unit cost per unit is determined by dividing total cost of goods available for sale by the number of units available for sale. Weighted average cost, 100,000 multiplied by 110, 200,000 multiplied by 100, 300,000 multiplied by 90. So we will get total cost of the inventory divided by 600,000. We get 96.667 rupees per kg. Now sale is 5. We will use this cost for both cost of sale and inventory. So 520 is sale, unit sale at 240 rupees, 124,800,000 rupees is sale. Cost of sale is 520 is unit sold multiplied by 6.66. So this is our cost of good. So 50,267,000 rupees. Now gross profit, sale minus cost of goods sold, 74,533,000 rupees. Now inventory will be, cost will be allocated at the rate of this average unit cost. 80,000 units are inventory, remain in inventory, so we will allocate this cost under weighted average cost method. So that is 7.7 million 33,000 rupees is inventory, will be shown on the balance sheet. Inventory valuation method, FIFO. Under FIFO method, we assume that oldest inventory unit required are assumed to be first unit sold. Ending inventory therefore is assumed to be consist of those inventory units that most recently acquired. Now sale is same, will be calculated as same as the earlier method, but cost of sale. So in these 520,000 unit, we will assume that first in first out method, we will 100,000 unit were first in. So we will assume that these all have been sold and its cost is 110. Then these 200 was second shipment. We will assume that this is second oldest units. So we will include all these 200 unit at a rate of 100. Then 220 unit will be assumed that from the third shipment, which is cost 90 unit. So total cost of sale is 50.8 million rupees. Now gross profit is, this is sale, and this is cost of sold, 74 million is gross profit. Ending inventory will be value at which cost? The newest cost. So newest cost is 90 rupees in this example. 80,000 multiplied by 90, that is 7.2 million rupees. Inventory valuation method under LIFO method. In LIFO method, the newest inventory unit acquired are assumed to be the first unit sold. Ending inventory therefore assumed to be consist of oldest inventory. So sale is the same as previous. Cost of sale. Now we will start from the last in, first out. So last in, so we will sell these oldest inventory as a whole under this assumption. So 300,000 multiplied by 90 rupees, then in these 520 units, 200 will be sold from second shipment, 200,000 multiplied by 100, and only 20 unit will be sold from the new, that is 110. Sorry, the oldest one. So cost of sale decline. Gross profit 75.6 million rupees. Ending inventory will be located this oldest one, 80,000 multiplied by 110, that is 8.8 million. So summary of the comparison table under, since there is declining prices under specific method 50,000, cost of sale is 50,600 million, 50,000 265, 50,800, 50,000 49,200. Ending inventory 7.4 million, 7.7 million, and 7.2 million, and 8.8 million under LIFO method. Total cost of goods available for sale 58 million, that is 58 million, again 58 million, 58 million. Gross profit 74.2 million, 74.5 million, 74 million, and 75.5 million. So there is declining prices. LIFO, cost of goods sold under LIFO is lower, and ending inventory is higher. If there was declining prices, then it would be reversed. This is all about today's lecture. Thank you.